All right, so let's begin and let's talk about your home loan EMI that doesn't seem to be cooling off just yet with no relief on the interest rate cut front. Do we see the high EMI going on for long? And if the rates fall, would we be seeing the transmission effectively? What should borrowers with high interest rate loans do? Let's decode all of this. With me, I have today Adhil Shetty, CEO, co-founder, bank.com, Arnav Pandya, founder, Moneyeduschool. Good evening and welcome to the show. And Adil, so from around 6.5 to 8.5%, few banks also have reached 10% of home loan interest rate. But looking at the current scenario, how would you like to analyze and the trajectory going ahead? What sense are you trying to make out of these high interest rate? For how long do you think the relief will be away from all borrowers?
Good question, Kavita. So let's look at the key data points. So firstly, the new home loan rates, the best rates, right, for people with a credit score over 750 with great record is closer to about 8.5% today. And this has gone up with the repo. Now, the general view in the market is given the RBI has left the repo rate unchanged and currently the stance is withdrawal of accommodation, that the repo rate will prevail for the next 6 months at least. Any relief or cut in repo rate when it comes is going to be towards the end of this calendar year. So people should expect that if they're on a certain home loan now, they should check to see if there's opportunity to save by refinancing. Because one interesting data point, right, is that spreads have actually gone down in the last 2 years because of intense competition in the market. What used to be a 2.7% above repo for the best rate has now come down closer to a 2.2% spread. So I think it's a good time for people to evaluate saying, is there an opportunity to save money by refinancing to a lower rate?
All right, but then how can you do that, Adil? How do you analyze that refinancing would be the right decision for you? How do you go about it?
So the first thing that starts is what kind of loan you're on now. So with the private banks, we find that 80% of people are on a repo rate loan and only 20% are on a base rate or a MCLR loan. With public sector banks, it's a little bit different because majority of people still are on MCLR and base rate. So you first check what is your rate now. So let's say you're at 9.5% today. You also know the best rate in the market today are 8.5%. What you can do is you can start speaking with the bank. You can check online various bank sites, or you can go to a neutral site like Bank Bazaar and say, for my credit score, for my loan amount, what is the best rate? Now, if you see that there is a significant saving, right? And I'll give you an example of what a significant saving can be. If you're able to refinance, and let's say someone has 10 years left on their home loan, if you're able to refinance from 9.5% to 8.5% today, right? Saving about 7,000 rupees on interest outflow over the next 10 years per lakh of home loan outstanding. Now, 7,000 or 6,500 per lakh is quite a bit. You're talking about a 10 lakh loan or a 20 lakh loan. So you need to calculate, if I refinance, what can I save? And is it worth the effort? Because there is some effort involved in refinancing your home loan.
Also, Arnav, along with refinancing, there has to be some other options like paying off part of your loan in terms of repayment, like a part repayment strategy. Can that be adopted?
Question here is that what is your financial situation and how much amounts do you have in terms of liquidity, because that can determine whether you should repay or not, and also in terms of what is the amount outstanding and the time period of the loan which is remaining. Normally the strategy should be that if you are in the early phases of the housing loan, which is a long term loan, then uh, repaying a part of it depending on cash availability is a smart move, because you will save a lot in terms of interest over the life of the loan. Because the way the home loan is, you will find that a large part of it initially goes towards interest and a smaller part goes towards the capital repayment. In the latter half of the loan, it's the reverse, because a large part of the capital is being paid off. So you need to consider that as an aspect which will determine whether you will pay off the amount or not. The second aspect which also you need to consider is whether this kind of repayment is suitable for your particular situation, and that depends also on a lot of factors and the kind of uh, financial situation that you are in terms of where do you need to allocate the money, in terms of repayment, investment, what are your other goals, and all those factors.
So, Adil, I also want to understand that has the have banks passed on the higher interest rates entirely, or there's an imbalance or a mismatch over here? Because you also have to consider a scenario where once the interest rate starts cutting, that too needs to be transferred effectively. That will take a much longer time to happen.
Yeah, great question, Kavi. So let's talk about the rising scenario and then the falling scenario, which will happen next year. So in the rising scenario, right, the good news from consumer side is competition is very high in the home loan market. So even though the repo has gone up 2.5% in the last year, if you look at new home loan rates, they've moved from 6.7% to 8.5%, so sub 2%. If you look at a similar data on a metric called weighted average loan rate, which the RBI publishes, the finding is the same, right? The loan rates, fresh loans, have actually gone up less than what the repo went up. And that's kudos to the regulator, right? Because the market is competitive, consumers with good credit scores can get good products. Now, let's come to the second scenario, which will start in 2025 when the rates fall. Now, for people with a repo rate loan, you don't have to worry because it's automatic. You don't have to take any action. Automatically, as soon as the repo rate goes down every quarter or every month, your home loan rate will go down. However, right, remember we spoke about people who took their loan before September 2019. Those people, right, might be on a base rate or MCLR. They have to think about it because there the transmission in a fall regime might not be automatic.
All right. So, in this kind of scenario, Arnav, we are also looking at a lot of data where we are seeing that household deposits have gone down and loans have increased. And this is the third year, if I'm not wrong, third financial year where this trend is catching up and in fact it's increasing. What's your take on it? How should we look at this current scenario?
Which one needs to look. One is that in terms of share, there is likely to be a bit of a reallocation within the household savings basket because of the fact that on one side, if you see deposits, even in this kind of higher income interest rate scenario, the rates which are available are not as high as they used to be during previous kinds of cycles where interest rates used to spike up. Coincidentally, what has also happened at the same time is that the equity markets are doing pretty well. So you see a lot of money which is actually moving from deposits and onto mutual funds. And this allocation has changed in the last couple of years specifically because investors have got used to this idea of investing through the systematic investment plan route. And that has also yielded them good returns, which is encouraging this trend. So if you look at the SIP figures, slowly from 8,000 crores, they are now 19,000 crore plus. The other aspect is also that the impact of this kind of lower amounts going into deposits is also being felt by banks because of banks, the loans are rising at a faster pace. This is the third consecutive year wherein the percentage rate of loan growth is higher than the percentage rate of growth in deposits. So these are also, I mean, making banks put in more efforts to raise funds and see if they can attract more deposits. But coming to the second part of your question, which is with regard to the loans, it also depends on the kind of loans that person is taking. Loans have obviously gone up, but if the balance or the mix in a person's portfolio is in terms of more unsecured loans and more high interest rate loans, then that is obviously a cause for concern because now the scenario is such that it's very easy to get a personal loan. It's very easy to get these kinds of pay now, buy later schemes, whereby you are loading onto credit for your normal spends. And these are not only higher interest ones, but also, I mean, if you have not planned this out, the suspect defaults and impact on your credit rating. On the other hand, if there is there are the higher amount allocated or say taken in the form of home loans, which are secured loans wherein you are building an asset, then that is not such a big cause of concern, because as your financial or your personal balance sheet grows, it's likely that there'll be more loans, but the kind of loans are more important.
Adil, let's also focus on the repayment strategy. And, while one has to really consider the entire investment kitty, if at all they want to go for a strategy where they want to make a part payment, what should be your first type of investment that you might just want to pull funds out of? How should you carefully look at your investment kitty and then go ahead with the repayment strategy from that?
Kavita, see, prepayment is a great idea. Just to give you an example, if you just pay 5% of home loan every year, 5% outstanding, a 20-year loan becomes a 12-year loan. So prepayment is a superb idea. Anyone who has the ability to prepay should prepay. The benefit is immense, right? Now, I think the only thing to keep in mind is, we are balancing different things in our lives, right? So, for example, we have certain commitments towards having a life and health insurance and term life and health. You might have another commitment saying, my child is going to go to school in 10 years to a university. I need to have a commitment there. We might have a separate thing, which is called like an emergency fund. If something happens, I need money for 3 to 6 months. Now, some of these commitments can't be stopped because you can't manage without term life or without health insurance. Because if that rare case happens, you're going to, be in a really, really bad state. So those commitments have to continue. Same thing has to go with the child's education, right? Because we can't say I prepaid my home loan, but I don't have, the funds ready for the education. So, where there are certain commitments and certain events we're planning for, like insurance, like education, those we have to continue. But where it's discretionary, right? One point to understand about a home loan is you are making and saving this 8.5% tax-free and risk-free, right? So it's very hard to get 8.5% return anywhere without risk, and that too post-tax. So if you have any discretionary amount available, by all means, it's a great idea to prepay your home loan.
All right, moving on to one small news update that also came last week or before that. Arnav, is about penal charges and the interest charged, in a form of penalty. What's the change over here and how will it benefit the borrowers?
So, I mean, this change was actually announced some time back, but is being brought into effect now. Now, the main part here is that whenever there is some problem with the loan, the banks have been instructed very clearly that this should not be like a petty interest, which means that the amount should not get added as interest and then compounded on the loan. The problem which is happening or which was happening in many cases is the fact that any such penalty which keeps, you are paying actually interest on the interest part, and this means that your loan amount gets compounded, which means that you have a far larger amount to pay back as compared to if that amount was not compounded. So the simple thing a person needs to understand is that if there is some penalty and which has been levied because of either late repayment or some other things, then this should not be compounded. It has to be charged separately and it has to be mentioned separately.
I think that's the time I have for this discussion today, although I do have a lot of questions, but then unfortunately the time is up. Thank you so much, Adhil and Arnav, for being on the show and helping our viewers strategize their loan repayment.
If you like this video, then like, share and subscribe to ET Now.